let's take a look at what all are constituted under the capital money market. Okay. So first of all, the money market. Money market is basically short term. That is less than 3 years. Okay. Then one of the most important things, treasury bills, T-bills. Mostly less than 90 days or 91 days. Okay. Then comes call money market. Money is available on call. Okay. Then you have certificates of deposits. What do you mean by certificates of deposits? Again, highly likely question. What do you mean by certificate of deposit? Yes. For example, there is a bank B1 or bank B. This will be issuing a certificate of deposit. Basically, it is a promissory note. What happens here is that I am a private person. I feel that if I deposit money in this, or not I feel, the bank will be offering a certificate of deposit. And this will be actually for a very short period, 3 months. This certificate of deposit, I am depositing, for example, I am depositing a minimum amount of 1 lakh. And I will be given a certificate of deposit, which has a very high interest rate. So the bank is in need of money. The bank is in need of money. So what it offers is that it actually offers a new deposit mechanism. That is certificate of deposit. You can deposit a certain amount, a minimum amount of 1 lakh is required. I can invest or I can deposit this amount with the bank, and in return I'll get a certificate of deposit. And the interest rate offered here is very much higher than normal deposits. That is why I am choosing to deposit here. This is certificate of deposit. Are you getting the point? For example, if I am putting a general fixed deposit, the interest rate will be 6%. Imagine. But in the context of certificate of deposit, the interest rate offered would be 15%. That is very high. And also, it is safe. Bank is safer. And certificate of deposit, the deposit can be invested or deposited for only a period of 3 months maximum. That is a short-term deposit. This is actually not very common now. It is very rarely used. It is not very common now. But you should know. It could actually, UPSC could ask questions. Okay. Then we have commercial paper. Commercial paper is much more what? Larger chunk of money is being pumped, where a commercial entity will actually be buying things or depositing money or accessing money. Not very important still now, but this is not actually a very common thing. Have you watched the series? What was that? Scam 1992, Harshad Mehta scam. In that, he is actually manipulating this thing, certificate of deposits. Using certificate of deposits, he is actually funding more money, and then he is actually caught. What was her name? A famous journalist. I don't remember exactly. It's actually a real event, not just see. Then we have capital market. First one, primarily the securities market, primary and secondary market. In it, we have primary, we have the initial public offering. The first time a company is going public. LIC had its initial public offering recently, not recently, in last 2 years. What is happening? LIC was a purely government-owned entity. Now the public can actually buy shares from LIC for the first time. That is initial public offering. That's initial. Okay. Then we have private placements. A company is going public, but to a limited number of players. I have my company. I'm running my company. I'm actually introducing some shares to be sold outside, but I will be defining a certain amount of people to buy that. Only a certain private group of people can buy shares from my company. That is private placement. Again, a kind of financial mechanism, financial market. Are you getting the point? In IPO, it is open to everyone. Everyone who is having a demat account. But in private placement, I am actually defining a certain amount of people or a certain type of people who can buy my things. They're actually different. Then we have secondary market, that is the equity or stock market. Once a company, for example, company C, a company C has gone public, that is, it has issued shares bought by a person P1. This is initial public offering, IPO. And from P1, a person P2 is buying after 3 or 4 months. This happens in the secondary market. That is stock market. Are you getting the point? In the stock market or secondary market or equity market, the share issued by the original parent company is being sold to another person. So a secondary sale is actually happening, or follow-on offering is happening. Are you getting the point? Then we have debt markets, particularly bond. Debentures. What do you mean by debenture? How is it different from bond? Debenture is actually very much similar to bond, but there is a qualitative difference. Not every company actually issues debentures, and not every company's debentures people would buy. There is a qualitative thing that actually differentiates debentures from that of bonds. Find that very important. And we have what? Convertible bonds. Bonds that can be converted to securities. And we have convertible debentures as well. Things that can be converted to securities. For example, I will be actually a person, there is a company, I would be lending that company. They might be buying my bonds. So I would be buying bonds from that company. And I have holding of a bond and I have lent to that company. I have offered money to that company and that company is paying me interest. And after some period, if it feels that the company cannot repay back the loan, then the company can convert it into a security. That is, the bond I am holding will be converted into a share in that company. That is convertible bonds. And there is convertible debentures. Recently, there hasn't been any news regarding convertible debentures. Debentures is actually very few in less in news. Bonds actually come, bond yield and bond relationship, study that, how bond yield increases with increasing bond price and all. Okay. Then you have to learn regarding, yes, another one is futures and options market. What do you mean by futures and options market? What is the difference between future and option? Futures, options. Futures means there is an agreement. For example, an agreement is actually made in today. And there is an agreement regarding an exchange of finances that a person R would be buying this thing in the future, at some time, 2025 June. This is a future. It would be a commodity that would be bought. For example, tomato. I'll be buying this much of tomato in 2025. For that, I have paid this amount. This is an agreement. This is a future. Commodity market. It happens in commodity market. It's a type of stock market. In the context of futures, he has the obligation to buy. Obligation and right. Right means he has the right to claim that, or he has to write the claim. For example, he would be offering something. He has the right to claim. At the same time, he is obligated to pay. For example, this person is actually offering tomatoes. In 2025 June, this person is obligated to pay. He should definitely pay that and buy that. In the context of option, it is optional. He or she need not buy that. He has the right to buy, but he need not have the obligation. Like, he did not buy. If he wants, he could buy. If he doesn't want, no. That is an option. Both are similar, but in future there is an obligation. In option, there is no obligation. Okay. Okay, shall we move to the next question? So, have a understanding of what markets are, how markets function, especially capital markets and bond markets. And what is the relationship between bond yield and interest rate? Very important question. Bond yield and interest rate. Interest rate in banking, bank rate. Interest rate you receive from a deposit you put in bank. Then there's a yield curve. Then there is one more thing. That was that. I don't remember exactly. This yield curve. What was this called? I don't know exactly. There's a situation that happens in this. This is the bond yield curve. Speculative. Remember exactly. I know the concept. I'll discuss that in next class. I'm not exactly getting the term. First of all, what is the relationship between interest rate and bond rate? For example, a bank B and there is a bond market BO. Okay. A bank B is offering 10% interest rate for its deposits. 10%. Then here is a person A. Okay. He has 1,000 rupees. A bank B is offering 10% and in the bond market, the interest rate is what? Also 10%. He can either invest here or here. But bank is much more safer. There is assured payments. In bond, there could be variance of bond price. Okay. For example, the bank rate is actually reduced, only 8%. The interest rate is actually reduced. What happens then? Here, the bank interest rate is 8%, and in the bond market, the interest rate is 10%. What happens? A is obviously opting for bonds because there is better interest rate here. Okay. And what happens in the bond market? Okay. So bank has reduced its interest rate. And in the bond market, there is greater interest rate, bond market. Okay. And a person A will be looking out for buying bonds from BO. So I am actually a company that is releasing bonds, a company releasing bonds. So initially there was no demand for my bonds. There was no demand for my bonds. Initially there was no demand for my bonds. Am I getting this correct? Now there is high demand for my bonds. Okay. So earlier, first that was that I was offering what 10% as yield because there is no other way. No person is buying. 10% yield means if I am selling this bond for 1,000 rupees, A is buying. I am getting 1,000 and I have to return every year 100 rupees. Are you getting the point? This is actually the interest the company is paying. Now the demand has increased. Even if the yield is low, even if the coupon rate is kept low, C actually reduces the coupon rate to 8%. There will be person to buy this because the bank interest rate is much lower, for example, 5%. So when there is a dip in interest rate, consequently, fresh issue of bonds will also have a dip in their coupon rate. Are you getting the point? Okay. So when the bank reduces its interest rate, what happens? There will be automatically there will be preference for buying of bonds. That is, demand for bonds actually increase. Demand for bonds increase. Demand increase means price increases of bonds. Existing bonds price increases, and new fresh bond issues happens. What happens there? The person who's issuing the bond, I'm a company, I will be looking for lower coupon rate because I am actually paying that interest, lower coupon rate. What will I do? I will actually reduce the coupon rate and issue fresh bonds. So an interest rate lowering means there is a high chance that there will be reduction of coupon rate of fresh issue of bonds. Okay, so understand the correlation. The yield is actually reducing there of fresh bonds. This correlation you should definitely know. There has been questions asked regarding bond yield and bond price.